Today in this video clip, we are going to practice how to measure the beta, the sensitivity of the individual of the market risk from the market return. Okay, our task here is to define and measure the risk of individual common stocks because the risk depends on the exposure to macroeconomic events, or even we measure it as the sensitivity of a stock's return to fluctuations in returns on the market portfolio. The sensitivity is called the stock's beta. Okay, in the last video clip, we have measured the portfolio diversification to reduce the standard deviation, which is the uncertainty of its own expected rate of return. There is no comparison between the expected rate of return of individual stocks and the market return. Okay, but the standard deviation is telling us only the risk, ignoring the market risk. And the diversification can eliminate the risk that is unique to individual stocks, but not the risk that the market as a whole may decline. When the market declines, and then the stocks in the market definitely will decline. Okay, so some stocks are less affected than others by the market fluctuations. So in order to avoid the market risk, maybe we could choose some insensitive stock, right? So the investment managers talk about the defensive and aggressive stocks, and defensive stocks are not very sensitive to market fluctuations and therefore have low betas. In contrast, the aggressive stocks amplify any market movements and have higher betas. So if you are a portfolio manager, if the market goes up, you expect the market goes up, and it is good to be in aggressive stocks, right? If you expect it goes down, it is better to be in a defensive stocks, right? So aggressive stocks have higher betas greater than 1. Their returns tend to respond more than 1-for-1 to returns on the overall market. So again, the 1 is the standard, right? The market beta. The betas of the defensive stocks are less than 1. The returns of these stocks vary less than 1-for-1 with market returns. The average beta of all the stock now, then, okay, no surprise here, just only 1, because all the stocks are the market, right? So let's jump into how can we get the beta of individual stock. We have E-based beta, which is monthly information, right? The rate of return. Then the expected monthly the rate of return of the market. We can calculate just the average, right? Average of this 12 months. Then let's stretch. So the expected monthly rate of return, the E-based stock is 1.39%, and then the Nasdaq market return is 0.87. What about standard deviation? Standard deviation, we use the standard deviation .p. I know we collected some sample, but again, be consistent. Let's use just population, assuming that information is in full, right? The population. So just use a standard deviation like this. So that is the standard deviation of its own expected rate of return. Uncertainty of expected rate of return of its own, right? But the beta is we can calculate using the slope function, okay? Known y. What is y and what is x is important, okay? We want to measure the sensitivity when the market moves, how much the stock is variated, right? So what is the y-axis? Right, when runs and the market runs and stock rise. So y is a stock, right? Then comma, known as x, which is the market historical rate of return. Then the beta is 0.78, right? What does that mean? That means the eBay's returns are 0.78 times as volatile on average as those of the overall market. Okay, when the market increases 10%, then the stock, eBay stock, would increase 7.8. When the market decreases the 10%, then we expect the eBay stock will decrease 7.8%, which means the less sensitive than the market the return. Okay, and then what is the beta of a market? Okay, beta of a market also we use a slope market versus market, right? Because XY axis we put the market rate of return. So exactly beta of market is 1. Okay, then let's draw the graph using that, the historical rate of return, a monthly rate of return, and then we want to know what the slope means. Okay, so we drag this area and let's use insert. Then we want to make the scatter chart. Oh, by the way, we just want to see what is the eBay axis. So let's include the name of stock and market. Then one more time, scatter chart. Okay, now you can see this the graph. eBay is y-axis, and then all the dots are scattered on the y-axis and x-axis. Okay, so in order to know the slope, which is beta, we just choose one of the dots and then click the add trend. So you see the trend line that explains all the dots in the middle, right? And then we click the display equation on chart. Okay, that's it. Then do you see? Okay, I will increase the font size. Okay, so 0.78 means when the market runs, how much the stock return up or down, right? The rise or fallen, right? So that explains the beta, which is the slope. Okay, using this beta, we also can the practice how to measure the required rate of return of individual stock, which is the capital asset pricing model. Then I wanted to remember the reminder of this equation. Required rate of return is a standard from the market, right? That all the stocks has its required rate of return. Then the individual investor has its own the expected rate of return. If they expect some rate of return is higher than required rate of return, then they invest, right? They invest. But if expected rate of return, the subjectively measured by the investors is lower than the required rate of return, then they reject this investment. Okay, they do not invest on it. So how do you measure required rate of return? Risk-free rate plus the equity risk premium. What does that? Risk-free rate is treasury bill, which is benchmark, not the benchmark, but the base rate, right? The base rate plus the individual risk premium of the stock. Then how do you measure the equity risk premium? Right, the market risk premium times the beta, right? That is the fluctuations sensitivity from the market risk, right? Then how do you measure the market the risk premium? The market rate of return minus the risk-free rate. That is the premium from the base rate treasury bill, for example. So if you have the market rate of return like NASDAQ at the average rate of return, then we measure the deviation from the base the rate of return treasury bill. That is the market risk premium, and multiplied by the beta of a stock, which is sensitivity of individual stock, and then we come up with the equity risk premium. Okay, so let's practice with this example. Apple has a beta of 1.4. Assume that the risk-free rate is 2.5, and this is, for example, the Treasury bill, and that at the market risk premium is 7.3%. What is the stock's required rate of return? Okay, let's put that information on this table. So beta of Apple stock is 1.4, and the risk-free rate is 2.5%, and the market risk premium is 7.3%. Then we use this equation, right? So 2.5% plus the market risk premium and the sensitivity of this Apple stock, which is beta, right? So 12.72% is the required rate of return on the Apple stock. Okay, that is the standard. Again, if investors expect higher than this, the required rate of return, their target, then they invest, right? But if they expect a lower expected rate of return on the investment of the stock, then they reject the investment. Okay. Sometimes you will be given not the market risk premium, but the market return. Okay. Then we use some different formula. Again, the Google has a beta of 0.95, and then the historical average Treasury bill rate is 2.5%, and that historical S&P 500 market return is 9.8%. Market return is 9.8%. Then what is the stock's required rate of return? Then risk-free rate plus market return. Now we have to calculate market risk premium, right? So S&P 500 market return minus the risk-free rate is the market risk premium, and times the individual stock's beta. So 9.44 is the required rate of return when the investors invest in this stock, right? They require this opportunity, the minimum rate of return. Okay, then let's calculate the required rate of return on the portfolio. Now, once we determine as an investor, determine to invest the Apple and Google stock by $60,000 or $40,000, that has different beta, right? Then how do we measure the portfolio beta? And then we apply this portfolio beta into this equation of required rate of return on the portfolio using the capital asset pricing model here. Okay, the weight is out of 100, right? Weight is 60 divided by 100. That is the weight of Apple stock investment. And then Google weight is 40%. So the beta times the weight, we want to allocate this weight into the beta. So 0.48 is weighted beta on the Apple. Then the Google weighted average weighted beta is 0.38, and then we can just sum up these two. Okay, so 1.22 is portfolio beta. Okay, that is the sensitivity of the sensitivity of this portfolio from the market. Okay, so portfolio beta 1.22, and the risk-free rate. Where is the risk-free rate? Okay, Treasury bill here 2.5%, and then market return, average market return, we are given 9.8%. Okay, 9.8%. Then required rate of return, one more time, risk-free rate plus market return. But market return is not the market risk premium, right? We should calculate it. How? The market return minus risk-free rate, that is the market risk premium, right? So that is the market risk premium, and then we apply the portfolio beta by multiplying it, right? So 11.4% is the required rate of return on the portfolio. So if you're a portfolio manager, you require the 11.4% from this investment. If you expect higher than this, then you invest in this stock. Okay, that's it. See you later.